Hello, and welcome to Between the T's, the knowledge sharing program from Texas Bank and Trust. I'm your host, Aaron May. So, now that we're a little over a month into the new year, the strong possibility is that you, like many of us, are receiving some wonderful reminders of the holidays. Ah yes, 'tis the season for credit card statements. Just as the decorations come down and the bright, shiny new toys from Christmas get nestled into the back of the toy box, comes the little white envelopes in the mail with the total balance due for all of those wonderful Christmas memories. For some of us, this was not a surprise. We knew it was coming, and we have a plan to pay for our balances in full within a few months. But if you're like the average American, these bills may feel like a wet, heavy blanket, drowning out the last spark of joy from those family gatherings. So while credit cards are just one of the many types and forms of credits out there, it is a great place to introduce this topic because it is likely where many of us got our first start into the world of credit. So to join us on this discussion today, I have my co-host again, Carrie Wilson. How are you today, Carrie?
I'm doing well.
Great. So how was your holiday season?
So my holiday season, fortunately for me, did not include a lot of credit card purchases.
That's good.
I really feel like 29 to 30, that's a great age, especially being single, no kids. You don't have a lot to worry about as far as buying things for people. So the most I did was looked at my savings account. I had enough money to buy this steamer that I've really been needing because I hate ironing my clothes.
Nice.
I grew up doing it, but I hated it, you know? So now being an adult and realizing I don't look great with my clothes being wrinkled. What's an easier way to get the wrinkles out? I went to Walmart, bought me a little $40, $50 steamer, and that was a Merry Christmas to me. And I bought that Walkman that I was telling you about.
I thought you'd just been going to the gym so that your shirts fit tighter and the wrinkles went away.
That too. You know, you have to look presentable in our clothes. But, you know, fortunately for me, I didn't have a lot of credit card purchases, so I'm just happy I don't have that white letter in the mail with the balance of something I owe.
So when you think of credit, if you would have to define it in one phrase, how would you describe?
I would describe credit as money being extended to you with the expectation that you are able to pay it back in a timely manner.
Okay. That's a very good explanation. I actually agree with that very well. That's a very good explanation. So we're going to dive a little bit more into this world of credit. We're going to define what it is, how it is built, and how we can use it properly. We'll also go into some of the common myths and some of the risks that are associated with misusing credit. So to join us on this discussion as we walk through this topic is our guest, Zach Gilbert. Zach is a vice president and commercial loan officer with Texas Bank and Trust, and he has a wealth of knowledge regarding lending and credit topics. He often speaks with our high school seniors in our Student Board of Directors program about this very topic. Zach, how are you today?
Doing well, guys. Happy to be here. Thank y'all for having me.
Yeah.
Yes, sir.
So let's just jump into our topic.
Okay.
So what exactly is credit?
So credit can be looked at a lot of different ways. The simplest way, in my opinion, to really kind of explain credit is trust.
Yeah.
And what I mean by that is I'm giving trust to an individual to pay me back.
Okay.
You know, and so as a creditor, like Texas Bank and Trust, as we extend credit to an individual, that means we're extending trust to them that they are going to pay us back. Good credit means we trust that it's easy to trust that this individual is going to pay us back. Bad credit, it's really kind of hard for us to trust that this person's going to pay us back. And so there's more factors that go into on the hard side, speaking of, if someone has bad credit and they're wanting to do a vehicle purchase, they might have a shorter time period to pay us back because we might not trust them for a longer amortization.
Okay.
They might have a higher interest rate because they're harder to trust. We're going to get what we want to in interest a little bit higher because they might not have the capability to pay. It's harder to trust them, and so we might have to. They're going to be penalized with a higher interest rate than someone with good credit.
Okay.
So a broad overview of credit, when you break it down, it's really a financial institution, like you're saying, extending the basic human instinct of trust to someone. You take and give as it comes based on their credit report and their history of paying things back. But really, it's just trust in a financial sense. Like, can we trust you with money?
Let's be honest. We all had someone in our childhood. We all had people in our childhood that we knew that if we gave Johnny $1 to go get a Coke, Johnny was going to bring us $1 the next day.
Right.
And then we also had that buddy who, let's just say Carrie. Now, I'm not saying for you, Carrie, but,
Right.
but we had that other friend that we'd extend that $1 and we're never getting that $1 back.
You already know.
And
you're
you
not
already
get it back.
know.
Exactly.
You already know that $1 is not coming back.
Right.
People have been doing this for years. We've been doing it for years with individuals in our own lives. We know that we don't need to give our brother-in-law money to go do something when we know we're never going to get that money back. We're not going to see it, right?
Right.
And so from a standpoint, we all do this. It's just with the banking institutions, with financial creditors, they have kind of a more rigid guideline to follow in terms of just based off banking regulations and everything else. They're going to be able to say, okay, you know what, you haven't made your payments on time in the past. You've let some things get repossessed. You've let some things go to collection. Your credit score is lower than what we would like. Therefore, for us to trust you, we're going to get a little bit more interest on this, and we're going to ask that you pay this in a more shorter, timely manner than someone that's had good credit that we know is going to pay on time. We can trust them with an extended with an extended term laid out over more years. That's kind of the difference there.
I remember being a teenager. Maybe I was a teenager. I mean, sometimes parents ask kids for money. Yeah. Sometimes. I remember it took my dad a few months to pay me back $20 I lent to him. So me having a little bit of knowledge on simple interest from 7th grade math, which I really, Mr. Jones was a tough teacher, but he taught us. So really great, awesome. I remember telling my dad, well, I'm going to need interest now. So that totals to, you owe me like $60, dude. And
how much interest were you charging him?
I was just trying to get more money, honestly.
Hey, you got to tell Pops. Sometimes, hey, the juice is running, man. We got to.
It didn't work. It did not work. However, I was thinking pretty early on about if you don't pay me back and you want more money, no, I need what you owe me plus more because I've spent this much time waiting on it. You don't know what I've needed.
Right.
I mean, I'm his kid, so obviously it's not like grandiose, but early on I remember having that same mindset. Okay, I'm gonna need this is interest.
Right.
So there's a lot of different ways that people use credit these days. I know, as we mentioned at the beginning, credit cards is one of the most common ways because it's how you typically first venture into what is a credit score, what is credit, how do you build credit. Credit cards usually where we begin, but there's a lot of different ways that people use credit, isn't there?
There is. And, like you said, credit cards are one of the first and one of the easiest ways, and it's also one of the most dangerous ways.
Yeah.
If it's not done properly, because credit cards have the highest rates you're going to see. And so if you don't know how to use that credit card properly, you can, and if you're only making minimum payments, it can really just kind of start to compound, and you can really kind of get behind. And if you're not watching those balances on a monthly basis,
Right.
But this is one of the topics when it comes to using credit and starting credit. That Carrie, you mentioned that you had a 7th grade teacher that kind of taught y'all simple interest, and
Yes.
what was his name?
Frank Jones.
Frank Jones. Well, I applaud you, Frank Jones, for teaching that to.
Thank you, Mr. Jones.
Thank you, Mr. Jones.
Yes.
For teaching that at such a young age, because it is such a crime today, in my opinion, that so many students and so many young adults are coming out of high school without any knowledge of this, without any knowledge of what an interest rate is, without any knowledge of what credit scores are. And yet we see the commercials all the time. Yeah. We see the commercials all the time. Right. You're seeing Experian. You got the Travis Kelce, doing Experian commercials now. There's credit score commercials. You see them every single day. Yeah. And the reason why you're seeing those credit score commercials every day, for the most part, is probably because there's a lot of people out there with bad credit and they need help fixing it.
Right.
And that's just kind of a indication of how much, how easy it is to kind of get behind, if you're without the proper knowledge. And so credit cards can be a great tool. They really can. They can be a great tool if used properly. To me, one of the easiest things to really kind of establish credit is just having a gas card, because you can only use it one place and it's at a gas station. You can establish credit with a gas card. It's a credit card. You slide it in, slide it out, pay it. All you're doing is getting gas with it on a monthly basis. You're not enticed to, go get that Walkman that you mentioned too.
Right.
Yeah. But now I know you pay cash for that. And so that's all well and good.
Right.
But it's one of those things where, that's a great way to start. Using just kind of merchant services, that can be a great avenue to kind of start with. Credit cards are a good way. And then one of the best things to do is kind of, for myself, how I established credit was on my very first vehicle. I co-signed with my father.
Okay.
And so even though I was the one making those payments, and there was no way, even though I had just started a new job, here at Texas Bank and Trust, we want to see that, you've been at a job for over a year or 2 years. We want to see that security that you can maintain that. Yeah. And so with me just starting a new job, I'm 17 years old, I'm starting a new job, I needed my father on there with me to help co-sign that. That way I could at least establish that, to get the loan to start with. And then as I'm making payments, my credit is starting to build from there.
So job history is another factor observed to determine that?
Absolutely.
Really?
Absolutely.
I personally didn't even know that.
Absolutely, it is. We want to see that you've been able to maintain a job for at least 12 months. Most of the time it's 2 years, but we want to see that. And if it's less than that, we need an explanation. Well, why did you jump from here to here, here to here? Those are the things we look at. And
I think it's so important for the younger generation, not even millennials, but I'm talking Gen Z and beyond. I've seen a trend on social media within the past year. They are reluctant to stay at a job longer than a year. And I saw a specific tweet that said, "You're crazy if you think I'm going to stay at a job 5, 6, 7 years. That's too." I'm just like, it's not bad to stay at a job. If it's a good job, it pays well. What's your issue with staying at a job? Because it helps for credit.
Yeah. Right. And we could go. That's an entirely different topic about this younger generation.
Okay. So we're about to take a quick commercial break. But before we do, I just want to say that this information we're discussing in this podcast today is for informational and educational purposes only. So if your financial situation is different than others, please reach out to a licensed individual in your area to speak with your financial needs directly. So we're going to take a quick commercial break. When we come back, we're going to discuss a few of the common types of credit, difference between open-ended and closed-end credit. Then we're going to go into some of the common myths and dangers of using credit inappropriately. So we'll be right back.
Hello, I'm Karen Partee with the TBT Financial Minute. If you've been a victim of fraud or suspect that your personal information has been compromised, contact your bank and credit card issuers immediately. File a police report, request a victim statement be placed in your credit reports, and keep a record of the authorities you have contacted. For additional information, call the Federal Trade Commission's ID Theft Consumer Response Center. TBT Financial Minute is brought to you by Texas Bank and Trust.
You've been an anchor for our families, a shelter in the storm, a refuge from uncertainty, and the one to keep us warm. You remind us of where we can go and just how far we've come. You've caught our tears and helped us sing our songs. You've welcomed our friends and embraced the ones we love. You've always been the first to say hello when we make it back to that place we call home. Wherever life takes you, the journey home starts here. TBT Mortgage.
All right, we're back from commercial break. Thank you guys for sticking with us. Right before the commercial break, there was a conversation, Zach, between you and Carrie about the importance of other factors that play into a credit decision. You were mentioning that how long you've lived in an area, how long you've worked for a company, all of these different things can factor into a decision when making a loan.
That's right. So with our consumer credit, we really we'll take a look at, how long you've been at your length of residence, how long you have been at your current employer, and if those are under, 2 years to 1 year, we really kind of want an explanation why, because these can play into a factor on your ability to repay. One of the things that I didn't hit on earlier when we were talking about credit is there are actually, what financial institution or lender will focus on, we call it the 5 C's of credit.
Yeah.
And those 5 C's are capacity, which that's really just kind of your monthly income and kind of current cash to help pay on a monthly basis. So what your capacity is to be able to make the repayment of that debt. 2 is capital. So capital is really kind of the wealth you have on hand, what's in your savings, what you have just in case. So that income that's coming in, if all of a sudden that's brought to a halt and there's no more job, we really like to know kind of how much capital you have, how much wealth you have to be able to get you to be able to make some of those payments while you don't have income coming in,
right?
While you don't have that resource coming in,
right?
How long are you going to be able to maintain those payments and maintain that repayment before you're able to go out and get another revenue, before you're able to get another income source.
Okay.
Like another job, for instance. And so that capital is another big important factor. 3 is collateral. We're going to want to, have certain assets pledged, just in case there is no form of repayment and you end up defaulting. We're going to go out there and we're going to take that asset so that we possibly can be made whole and sell that asset, and which is what you hear about repossessions.
Right.
That's what that comes into. Foreclosures on houses. That's where that comes into effect. And then conditions. What are the conditions of the loan? What are you going to be using the money for? And then also external conditions. For instance, I doubt very many people were making loans to restaurants during COVID because nobody could go in.
Right.
So even though it was very hard to, any kind of service industry like that, if they were needing a loan, it was very, very tough for us because it's, how are y'all going to be able to even, generate the revenue to service this because you're closed right now? So there's external conditions as well. And then the 5th is character, and character really plays into what we've been talking about: credit history, credit score. That's kind of all of the historical, on a historical basis, how have you handled all of your credit in the past? That kind of speaks to your character. Have you been able to make payments? And so that really kind of goes into speaking about the 5 C's, you can kind of include all of that. And then when you're talking about the length of residence, the length of employment, those factors are in conjunction with everything else that you're, looking at as well, based on the credit history and credit report.
Makes sense.
So one of the things I wanted to touch on very briefly is what are the different types of credit? I know there's open-ended credit, like credit cards and stuff like that, and then there's closed-ended credit. So can you describe a little bit of the differences there?
Right. So open-ended credit means that there's not a term at the end. You're not paying it down to you're going to have a final payment on this date in 2029. So really what open-ended credit can be a personal line of credit. It can be a credit card that just renews, and that happens quite a bit. You'll see that. It can be a home equity line of credit. So if you have a lot of equity built up in your house, you may, if you own your house free and clear, or if you have a lot of equity, you can borrow up to 80% loan to value. So whatever the value is of your home, you can take out a loan up to 80% of that value is what that means, and do and it's called a HELOC, a home equity line of credit.
Okay. And
so, however, Texas Bank and Trust, we offer a 10-year HELOC on that, and it can renew at the end of that, but that's an open-ended line of credit versus a closed-end, which is what you typically see with that's going to be a vehicle loan. That's going to be a home. That's going to be an actual home mortgage, 30-year mortgage, or however, whatever kind of term you want set.
Right.
But that's going to be your typical term loan. If you want to go get a new toy that's an ATV, if you want to go get whatever it may be, those are going to be term loans. Those are going to be a set principal and interest payment that's going to be paid down over the life of the loan. And as the more payments you make, the more principal reductions you make, that interest will get lower until there's finally a final payment. And so with a set maturity date as you open the loan, as the loan starts, there is a set maturity date to where that payment will be, the balance will be zero.
So term loans typically have an amortization, how do you say it? Amortization table?
Amortization.
That trips me up so bad, that word. I don't ever since, yeah. But would that specifically be for term loans as opposed to credit lines?
That's a great question. Because credit lines typically are interest only. There's no amortization. So you're not having, you make principal reductions when you can. So for instance, where we see a lot of lines of credit are with businesses. Right now, the cost of doing business, it has gone up with this economy that we're currently in. There's been inflation, so there's less cash on hand. Right. So there's been a lot of businesses requesting lines of credit or asking to maybe extend lines of credit to that way they have the ability to go out and make their goods, whatever it may be. Mm-hmm. That way they have more cash on hand to be able to do that. And as they receive the revenue from those goods being sold, they can then come in and pay that balance down.
Okay.
So, we want to see it revolve. We want to see people draw up on a line of credit and when they, to make their goods, but then when they receive that revenue in, we want to make sure that part of that revenue is going to pay down the line and go kind of back down to zero. Right. We want to see it revolve like that.
Okay.
And so that's the whole point of a line of credit. But But one thing I want to state is while that line has a balance, while it's being drawn up on, mm-hmm. they're only making interest payments on the amount that's being that's been borrowed up to that point.
Okay.
And so it's whereas a term loan, you're making both principal and interest payments.
Okay.
Which is the amortization you've referenced earlier.
Yes.
Gotcha. So I want to discuss a couple of the common myths that a lot of people have about credit. I know you have a couple that we discussed on the phone, but one that I feel like I hear so often from people is, I'm just using other people's money. I can use someone else's money to buy whatever it is, and I just have to, pay little bits here and there. But that's more than just using other people's money, right? Because those other people at some point want that money back.
That's right. Yeah, I mean, a lot of times what you'll see is, you're borrowing that debt to create a better way of life.
Right.
Whether that's, you want a shiny new vehicle, whatever it may be, or sometimes it's to generate wealth. And so say somebody comes into an inheritance and they want to use that money to go invest in a new property. Okay. So they're going to use that. They're going to go buy a rental property. They're going to pay cash for it. They're going to make some improvements to it. Right. Mm-hmm. So if they want to keep generating wealth, what they will do then, they paid cash for it. They've made the improvements with cash. What they will then do, what we will see is they will take out a loan, a cash out loan, borrow up to 80%, like I mentioned earlier, on that property. Okay. And they'll use those funds from that cash out to go buy another property.
Okay. So, right.
And so, but because that's a rental property, they're not having to pay the P&I on that. Mm-hmm. The lessee is, who's leasing that property from them because it's a rental property. So they're receiving rental income. That is an income producing property now. So they are receiving that income to help pay that P&I. So that's not even, it's not even really. And now they are using the to pay that loan that they took out to go buy another property. Mm-hmm. Now they're able to go buy another property, try to turn that and flip that into a rental property, or possibly just flip it and sell it, whatever their prerogative is.
Right.
But that's how you generate wealth, using borrowed money.
Okay.
That's really just kind of that's really kind of the simplest way to put it is, using that as an example, because now you've got multiple assets that you're using borrowed money, but you're also receiving rental. You're not having to pay that. The tenant is paying for that P&I payment.
So the biggest factor, it sounds like, to consider there is make sure that if you are going to borrow money for generating wealth, is to make sure that what you're wanting to borrow the money for provides you more than what the cost of the funds are.
That's right. Yeah. You want to make sure that there's going to be a return on that. And, for a bank like Texas Bank and Trust, we're going to want to see that you've before we extend that line of credit, that there is a plan in place, that you have, a good business sense, that you've done this before, you have knowledge of, the industry, there's other factors that come into that. But that's one of the best ways when we're talking about, borrowing other people's money, you're borrowing other people's money. And we, as a creditor, we're not letting that just, here you go. We're getting interest on that because really, and for, don't want to assume with anything with this podcast, but for those listening, interest is a percentage of the loan that's paid periodically to the lender for the privilege of using their money.
Right.
We are going to charge interest and receive a percentage of that loan balance for you to be able to go and start your enterprise.
Understood. Can we use the rental property example as kind of the baseline for my next question?
Sure.
Okay, so let's stay with that. So someone is getting a cash out loan, I believe you called it?
Correct.
Cash out loan to buy rental properties. And they're using that to generate wealth for their family for future generations. Is there a limit on that? Like, can you have too much of that to where it negatively affects your credit, to where lenders won't want to lend money to you?
Not necessarily. When I would say is there a limit to that is when there's too much exposure, and that we can really kind of we can really take another avenue here and kind of getting into debt versus net worth, and so there's a whole different avenue that we probably need to do.
I think that might be great for our next discussion that we'll have next time, where we'll talk about when a good credit score is not enough. So we'll save that part for that discussion, because I think that's very valuable.
And I think something else, as far as one of the common ways to, where you're using other people's money to try and help generate wealth or generate a better way of life, student loans. And so, a lot of people, they take, their doctors, it's hard to afford medical school. It's hard to afford law school. It's hard to afford these. And so they will take out student loans to try and provide for a better lifestyle, a better occupation, a better job. Now, the one of the biggest factors is people really, you really have to make sure that, you're not biting off more than you can chew, because, there's a lot of times people get into a lot of student loan debt, and when you get into this student loan debt, it can be an insurmountable amount that, based upon how much you're going to be making coming out of school, was it really worth it? And so, because student loans aren't always it. I'll say that in terms of just loans in general, you really need to understand, you need to be asking yourself certain questions. Is this a luxury item? Is this something I need to do? Is it something I can afford right now? Should I save up and just pay cash? Yeah. These are questions you need to be asking, because, for instance, there's a lot of kids that go to school right now, that go to universities and institutions, that they're there to have fun.
Yeah.
And really, if you're doing student loans, you really need to be knocking out as many classes and doing it as quickly as possible, because it's on those student loans add up on a yearly basis.
Absolutely.
They don't know. It doesn't matter how many classes you can take.
Yes.
And so one of the best advice that I ever heard was treating college like it's a job.
Yeah.
Whether or not you are there, I'm getting on a tangent here, but whether or not you have a class at 8:00, or whether or not you have a classes until 5:00, you need to be on campus from 8 to 5 and treat it like a job, because then you can be studying while you're doing, and then taking as many classes as you can. Because if you're able to graduate from a 4-year university in 2.5 years or 3 years, guess what? You're going to be a lot better off in terms of student loan debt when you're graduating and starting in the workforce, versus that person who had a little too much fun. It took 5 to 7 years to graduate.
And that was my father's main thing with me when I was in college. He said, look, you're in college. I know you're going to want to party, but just remember, we're taking out student loans.
Right.
The main thing is for you to go get good grades so you can get a good job.
That's right.
After school. Because student loans are no joke. I still have them.
And, there are for some, you don't have that luxury. Some, you're having to take classes when you can and work,
Absolutely.
Right.
And there are other individuals who, if they are fortunate enough to, to not have to have a job while they're in school, that was really what I was kind of thought I mentioned earlier, if you're fortunate enough to where you're able just to kind of go to college and not have to have a job, you need to treat college like a job.
Absolutely.
Right.
That's what you need to be on there 8 to 5.
Absolutely. So we're going to take another quick commercial break, and when we come back, we're going to discuss some of the dangers of mismanaged credit and then focus on what we can do to properly and wisely build an effective credit score. So we'll be right back.
Hi, I'm Greg, and this is a 60-second 411. Let's talk about credit. What is it, and how do we manage it? The term credit typically refers to a relationship with a financial institution where you have borrowed money either in the form of a loan or credit card. Borrowing money may allow you to make a large purchase that can be paid back in smaller amounts over time. Each payment includes a portion that goes toward the amount borrowed, called principal, and a portion that covers the cost of borrowing the money, called interest. When payments are made regularly, you will begin to develop a credit history, which is translated into a score by credit bureaus. This score helps other lenders determine your ability to repay loans and use borrowed money wisely. Keep in mind that borrowed money must be paid back in full. Consider using a budget to plan your spending accordingly so you can make your payments on time. We hope you've enjoyed this quick tutorial. If you have any questions or would like to speak with a lending officer, visit www.texasbankandtrust.com. Until next time, this has been your 60-second 411.
All right, and we're back. Hey, Carrie, while we were at commercial break, you had a great question for Zach, specifically about young borrowers.
Yes, Zach, there are common misconceptions amongst the younger generation regarding credit. What are some common questions you get regularly from young borrowers?
So it's a great question. And a lot of times, a lot of young borrowers don't even know what they're asking. And so it's really kind of more, I would say there's more naivete, there's more unawareness from a young borrower than really is just kind of, they don't even know really kind of what questions to ask. And that goes back to, like you mentioned earlier, Frank Jones, great job on teaching kids at a young age, because there's just so many kids that don't understand what credit is, how to build it, and just really kind of establish that and gaining that knowledge. And so, we'll have young borrowers come in not realizing, like we stated earlier, that, jumping from job to job can have a negative effect on your application, right. Because we want to see consistency. Sure. We want to see that there is a regular source of income that's going to be there for repayment of that debt.
Right. Do you have an example of
there's too many of that.
Okay.
To be honest with you, there's too many individuals that will come in and they've either left a job currently, or and a lot of times what it'll happen is they've left a job and they're needing just a small installment to just kind of make it through to get to the next one. Well, that's really, we need to see that there's a source of repayment, and it's, we'll hear, well, I've got interviews set up. That's not how this works,
Understood,
and so,
yes.
That's just kind of, like I said, I think it's more of there's an unawareness, and that's really where our role as community bankers come into play. Because here at Texas Bank and Trust, we are community bankers, but first and foremost, we're advisors.
Right.
And so if someone's coming in and they're wanting a loan, or they're wanting to go buy out and purchase this, and they really don't understand, what debt to income is.
Right.
And so, they may be at 45% debt to income already, and they're wanting to go out and purchase this vehicle. We really need to sit them down and say, hey, you're starting to kind of get over leveraged, with what the amount of money you have coming in versus going out. Anything can, if anything happens to where you're not able, that vehicle can break down. Now you're having to go either get repairs or find another vehicle, and then there's another payment, and it can just snowball.
You mentioned debt to income. Explain that a little bit.
So debt to income is what, you're your monthly debt, so whatever kind of debt payments you have on a monthly basis versus the amount of income you have coming in.
Okay.
So if I have $1,000, if we're just going to keep it easy math here, if I have $1,000 income coming in, we want to see no more than basically, I'll just say $400 in debt on a monthly basis.
Okay.
And so our limit is 41% on a DTI. If it's above 41% DTI for any kind of consumer loan, which for the viewers and listeners, that consumer loan is what we would consider a vehicle purchase, any kind of personal line of credit, personal loan, whatever kind of consumer debt. We will if your DTI is over 41%, that is that is for us with our policy, that is reason to deny right there.
Wow.
Now there can be other factors that make us, consider it, but that's a reason for a denial right there if it's over 41% DTI.
Okay.
So Zach, do you have any specific examples of situations where people have overexposed themselves and used debt or used credit inappropriately?
I think the easiest example that we can give that it really kind of affected everyone across the country was 2008 in the housing crisis.
Right.
Okay.
In 2008. Or the years leading up to 2008, there were so many individuals that were being granted loans that didn't have the income. Some of them didn't even have jobs, but these institutions were granting them because big investment banks were taking these loans off of their books. And
Right.
so when that happened, these loans were getting approved on adjustable rates. They weren't fixed rates over long periods of time. So these adjustable rates, when they adjusted, all of a sudden these rates went higher. These higher rates, people couldn't afford their payments anymore. And then that led to foreclosures. That led to repossessions. That led to and everything just kind of getting taken away in the blink of an eye. Well, then that leads to, nationwide property values going down. And so, that's, for me, that's one of the easiest ways to kind of show how someone can, be over leveraged. And that's where, kind of the role of a community banker comes into place. That's our role.
Right.
We need to have a relationship, and we need to be able to have that conversation with our customers to say, hey, right now, I really don't think, this is, that you have the capacity to be able to, manage all these properties or have all these properties or, go out and buy. And that's where, for us, that's where it really kind of comes into place as a community banker or as a community lender. And
one of the things I've always thought of whenever, when I bought my house and stuff like that is just thinking of, while a bank looks at certain factors like your debt to income ratio and your income and all of this stuff, the things that they can't consider is everything else you spend your money on. The bank didn't ask me how many streaming services I had.
that's right.
The bank didn't ask me what my grocery bill is.
Right.
The bank just asked me, do you have any credit cards? Do you have any loans? Do you have any specific bills? How much money do you have in savings? They didn't ask me, about my lifestyle.
How many vacations do you go on a year?
Yeah.
Do those are, your consumer spending habits, that's hard for us to monitor.
Right.
But I'll say, in the role of a community banker, we are going to have more of we're going to have our thumb more on that pulse of your spending habits because we're going to know you, right?
Definitely.
We're going to kind of know, this individual typically what's coming in, what's coming out on a monthly basis, what kind of, how they're, when they make deposits, what kind of transactions, come out.
Right.
We're going to know that. So we're really going to have kind of, our thumb more on the pulse than, what big bank would.
Yeah.
So, Zach, if someone is facing a tough time, like they lost their job, maybe they have a medical situation or something of that sort, insane inflation that changed their ability to pay back a loan, what should they do?
One, I would hope that they would already have a relationship with their community banker.
Okay.
I would, because that's going to be the most important thing. Us having an understanding of this, this is not typical behavior for this customer.
Yeah.
Right.
This is, they've been with this, with our institution for 5, 10 years, 20 years, and we've never experienced this with them. we're going to give a little bit of leeway there because we know that this is not standard for them.
Right.
Now, we are probably going to want to know, hey, what is the action plan
Right.
forward?
Right.
When can we expect, when are you going to be able to, get this, start payments again? But, there's going to be a lot more leniency with this with that customer coming from us because we're familiar with them. We've established that relationship, and that's really what we are. We're relationship-based bankers. And, there's a company that has been with Texas Bank and Trust for many years that actually suffered from an internal embezzlement. And for, CEO, CFO, they came straight to us. They let us know, hey, this is what happened. They really, there was going to be an issue, and it was going to be, they were needing us to work with them. We required kind of concessions from the CEO as well. He had to pledge a lot of personal assets to really kind of make up a lot of that ground, from just what happened with that internal embezzlement. And we spent many years working with this company because we knew that they were making an effort. We knew that we believed in them. We believed in their leadership. There was just, they were fooled by this individual,
right?
And now that company is doing 2 to 3 times what they were prior to that embezzlement, and they are doing an amazing job. They're flourishing. Their business is booming.
Yeah,
and it's just and credit to them for when we talk about the 5 C's and character, that was the most important. That was the most important factor when we were looking and helping that institution. Was we knew their character.
Absolutely.
We knew that they were going to do whatever they needed to make this right. And so we worked with them, we helped them, and now that company is far and ahead what they were prior to that embezzlement and to that incident. And
that's
so
fantastic.
That's why it's, to have that relationship with a community banker is so vital because, that's when we're able to help to where, a national bank who's not familiar with you, who doesn't even know your name, might turn the other way.
So a community bank may not always be able to resolve the issue itself, but we can work with the customer to minimize the effects
Correct.
of that issue.
That's a great way to put it. I like that. I mean, we might not be able to solve it, but we're going to do what we can to minimize the loss.
Right. So let's just talk really quickly about some of the ways that people can establish credit wisely as opposed to, flying by the seat of their pants and coming in not knowing what they're doing. I've heard a lot of people talk about using like a secured loan, taking out a CD that's about the same value. Does that actually work?
It does. And one of the things that we offer here at Texas Bank and Trust is a credit builder loan.
Okay.
And that can be for 12 to 24 months, however you want to pay into it. And what you're actually doing is you're paying money into a CD. Okay. So you're paying money into a CD, and when that, whatever kind of term, whether you set it for 12 or 24 months, when that term is up, we actually then release that CD to you and you get all that money back.
Oh, wow.
And so, that's a great way to be a credit builder. Now, I should say that option is made for a credit builder. That's for people who are starting out with 0 credit.
Okay.
That is not for people who have bad credit.
Okay.
Okay.
Yeah.
That's 2 different things. 0 credit, no credit does not mean the same thing as bad credit.
That's another great myth.
Yeah. So, someone who's never had a credit before, a credit builder loan is a great way because you're just putting in monthly payments, into a CD. Once the life of that loan term is up, we can release all. You can keep it in the CD, or we can release all of that cash back to you.
Right.
And in the process, you've now established good credit.
Absolutely.
So that's a great way to start.
It's a great way. A lot of teenagers will come in, upper teens, they'll come in with their parents to the bank, and the parents will inquire about building credit for them, and that's one product that we did sell a lot of, at least when I was in retail.
Yeah.
And the CD secured loans, just you can. It's the same concept, except it doesn't require 0 credit.
Right. Yeah. A CD secured loan that helps with people with bad credit because basically what that is, you can say you can take out a $5,000 loan, but you got to put $5,000 cash as collateral,
right?
As that CD.
Yeah.
And so you can use that, and as you can draw up on that line, or just take out that, or if you're just wanting to take out the $5,000 up front, and then just make installment payments as you pay it down, just like a term loan.
Okay.
You can treat it like that, or you can you can treat it as a line of credit, because the bank is, at that point, the bank is 100% secured. We've lent out $5,000, but we have $5,000 in that CD.
Exactly.
So where if you don't make your payments, we're getting our money,
right?
And so, but that is, for someone with bad credit, a CD secured loan is a great way to try and build back that credit.
Definitely. Zach, thank you again for being on the show today. This has been very insightful. I'm looking forward to our next discussion where we go a little bit more into what factors go into making a loan decision beyond just the credit score and beyond just the basics of credit. So looking forward to that.
No, thank y'all very much for having me. This is a passion of mine, so I appreciate being on here and allowing me to, give you my 2 cents.
Absolutely.
Great discussion.
That is all the time that we have for this edition of Between the T's. We would like to thank Zach Gilbert for being our guest today. Once again, the information that we discuss is for informational and educational purposes only, so please speak with a trained professional in your area about your personal financial situation. Between the T's is a production of TBT Studios and Texas Bank and Trust, member FDIC, and equal housing lender. All TBT lending products are subject to credit approval. If you live in one of Texas Bank and Trust markets, we'd love to be your bank. But if not, we hope this content is useful for you no matter where you live. So join us next time as we continue this discussion on credit with an evaluation of when a good credit score is not enough. We will dive deep into the factors that affect loan approvals and credit worthiness. But until next time, remember that knowledge is always power when it is shared between the T's. Thanks for joining us.